So good morning, good afternoon, good evening, everybody, and welcome to today's webinar on differentiated demand for low-carbon ammonia and nitrogen fertilizers. My name is Patrick Effer. I am the Deputy Director General at the International Fertilizer Association, and I will be moderating our discussion. So this is the fourth and last webinar co-organized by the Rocky Mountain Institute, RMI, and IFA on the theme of the journey for low-carbon ammonia future. So the fertilizer sector, as you may know, is responsible for a significant share of global emissions, but it is also a sector where decarbonization is both urgently needed and also increasingly possible. And one of the key to unlocking this transition is to create differentiated demand, ensuring that buyers, from farmers to companies, including governments, recognize and value the lower carbon alternatives, creating the market signals producers need to invest at scale. So today we are fortunate to have three distinguished speakers who will bring complementary perspectives. So we have Thomas Courblanc, Managing Director at RMI, who has deep expertise in market structuring and global demand signals. We also have Andrew Alcorta, Senior Director at the Center for Green Market Activation, GMA, who works directly on unlocking and aggregating demand for low-carbon products. And we have José Antonio de las Heras, CEO of Fertiggy, who is leading efforts in Europe to produce low-carbon nitrogen fertilizers. So our goal is to better understand where differentiated demand is today, how it can be structured more effectively, and what next steps are, let's say, needed for the industry, but also policymakers and producers to accelerate adoption. So we'll begin with 10-minute presentations from each speaker, followed by moderated discussion, and you will have time to ask questions. We'll try to keep at least 15 minutes for Q&A. And you are encouraged to share your questions using the Q&A function as we go along. With that, let me start by turning to Thomas. So Thomas Courblanc, again, who is with RMI, and Thomas is going to talk about global demand signals and market structuring. So over to you, Thomas.
Great, thank you. And I'm happy to be here, first of all, and thanks everyone for joining and spending a bit of time with us to talk about this particular topic. So I will start with more of the framing of the challenge and the reason we have invested quite a bit of time ourselves and together with partners into this topic, the fundamental needs and the market gaps that we're trying to solve for in this work. And then hand over to the other speakers to go in a little bit more into the solutions that we're creating. So on the needs side, well, first of all, and this is, I think, one of the important framings, which is that heavy industry as such, or the sectors in our economy that are challenging to electrify, represent a substantial share or more than the remaining carbon budget that we have. So, of course, this is not a forecast, but more of a scenario analysis, but just looking at the remaining 2-degree carbon budget versus the expected emissions from these sectors, you can illustratively see that you can't fit it all into the bubble, right? And that just means that, of course, even if we solve all the other challenges in all the other sectors, we clean up our power system and we get the personal mobility sector decarbonized, these heavy industry sectors alone will be contributing enough with greenhouse gas emissions to lead to a likely more than 2 degrees of global warming. And translating that into more practical numbers, when we look across multiple sectors, we really need to start building new production assets very soon, because in these sectors, if honestly, whether you can electrify or not, there are some limitations on the amount of retrofitting you can do. Of course, in the cases you can, that's great and might be a lower cost pathway potentially to decarbonization. But in many cases, the underlying process is impacted, and you need to replace or sort of build into growth of the sector, or find other ways of transitioning assets from current operations into a new operating setup that has much less emissions. So this will translates into a lot of assets built already in the 2030 timeline. And of course, if you look forward to 2050, these numbers are substantially higher, because we're at the beginning of an S-curve where we are just starting to see first-of-a-kind projects pass final investment decisions in some sectors. We have a few examples of where we actually have projects that are producing low-carbon commodities already, right? So here's the more specific pipeline progress against targets. We have some sectors that are notionally going to meet their target by 2030, but as you can see, a lot of these bars are inclusive of announced but not yet announced project without investment decision on them, which is getting close to a very tight timeline. If this is a 2030 target, projects that have not passed final investment decision likely have a couple of years of construction timeline associated with them. So the likelihood or the feasibility of actually constructing all these announced projects is increasingly challenging, I guess, in this timeline. But at least there is a pipeline, and with the right policy and business environment, this pipeline can be activated. And if we activate this pipeline, we can actually get construction going so that we reach the target. So the differentiation of the commodity, I think there are basically three reasons we do this, why we think it's needed. Number one is that the physical product delivered to the customer is the same. So you cannot, as a customer, tell from what you get delivered to your factory door whether you bought something with a lower carbon footprint or not. You can't sample it, you can't test it, bend it, or break it, or do whatever you typically do to test qualities of your product, burn it, I don't know, like you cannot test, it's the same. The second is that in a lot of these supply chains, there's no single buyer who has enough volume to influence the investment decision of even one production facility. So that means that the current business models aren't, or the supply chain structures are not necessarily set up to allow for that kind of customer influence. And the third is that we in longer supply chains where there are multiple handovers from sort of the production sites to the ultimate customer, both demand signals and price premiums get diluted with every handover of product, which means that we're basically creating inflation and deflation in the opposite ways that we would like it to be, right? So we've done this a lot, I would say, and this is just, I think, a few examples of the areas we've been in. So across from left to right, electricity, natural gas, shipping fuels, aviation fuels, and steel are areas that we've worked extensively on establishing differentiated supply chains with a combination of demand aggregation, performance standards and certification, and procurement models and transaction models that are transparent and robust. So this really goes, this is a different version of the last slide, but I think with a very important addition to the right, which is around, finding the right collaboration models with partners in this space. It is, of course, each sector has its own starting point. There are already existing work in different aspects of from the certification to procurement to whatnot in each sector, and we are committed to finding ways of working with existing partners to sort of build on all the great work that has been done towards really getting these projects over the finish line, right? As an example, we are currently running something called the Sustainable Steel Buyers Platform. We've, in this work, just finished a first RFP or a procurement round for low carbon steel. And it required multiple elements because that was, reflective of the maturity of that industry at the time. So a combination of real hands-on support in procurement, developing the underlying even offerings and solutions, and then, of course, bringing multiple buyers together to go to market. But even then, we were building this on, again, a lot of already good work that had been done in terms of getting corporate targets and pledges in place, and, an ongoing portfolio of work on operational improvements and sort of scrap recycling and whatnot. I mean, these efforts have really been enabling, I think, for us to support the buyers in this case to ask the supply chains for a differentiated commodity. This slide, I will just say one thing, or actually two things. One is, it is a complex supply chain that we're now getting into on the fertilizer side. So we are specifically doing some work together with the GMA team, and Andrew will speak more about that in just a few minutes. In terms of details of this slide, I will actually simplify it to the fact that the willingness to pay for a lower carbon product is all the way to the right of this slide, and the investments need to happen all the way to the left in this slide. And everything in the gray box is more or less untouched in terms of supply chain structure and setup, or could be. You could imagine new supply chain structures, of course, but there is a model here where you maintain that pretty much intact, which is one of the insights that actually helps us craft a solution that we think fits well with this particular sector. And with that, I'll leave out with just an invitation, and we can send the details afterwards, of course, but we are likely going to run out of time after the few questions we can answer. And as an invitation, come talk more if you like. We have some time during Climate Week next week where we can meet in person, or of course, feel free to reach out separately after this webinar.
Thank you very much, Thomas, and for sharing these very valuable insights, and as well for highlighting the complexity of the agri-food value chain, which is probably more complex than many other value chains. So now I'm pleased to welcome Andrew Alcorta, who is the next speaker, who will dive into, let's say, how to activate and coordinate buyers, basically. What are, let's say, lessons learned as well from other sectors. So over to you, Andrew.
Thank you, Patrick, and thank you all for coming and listening to a little bit about how we might be able to activate these value chains and differentiate low carbon products. I'll also quickly thank Thomas for what I think was a perfect tee up to the work that the Center for Green Market Activation, which I represent, and RMI are pursuing together. And so it's no coincidence that those last couple of pages were actually a perfect segue into what I'm going to be talking about. If you go to the next page, we want to start diving a little bit deeper into the agri-food value chain, as Patrick mentioned, and specifically into ammonia and fertilizer production. And so I have a couple of scene-setting slides here before I dive a little bit deeper into the solution that we are pursuing across GMA and RMI. So the first thing that I will note here is when you think about ammonia, and I think you can more broadly generalize this to fertilizer production, it is easy to forget that it is actually on a unit basis one of the most emissive commodities that we produce as humans. And so even when you compare it to some of the other hard to abate sectors, steel, ethylene, and the petrochemical production process, and cement, on a unit basis, ammonia actually produces more greenhouse gases than any of the other commodities here. When you multiply that by the roughly 130 million tons of ammonia that's used in agriculture each year, you end up at a half gigaton, or about 1% of the total global emissions that we are going to have to manage, to the slide that Thomas shared on the carbon budget. If we move to the next page, I think the good news here is we know exactly where these emissions come from, and they're actually concentrated in a small number of steps in the fertilizer synthesis process. Now, obviously, this will differ slightly depending on the type of fertilizer that you're analyzing specifically, but in general, it is the hydrogen and the ammonia synthesis that are the bulk of this problem. The good news is we have the technologies, and we really do know what the technologies are to address these emissions. When you look at other sectors, there is still meaningful debate. For example, if you take petrochem more broadly, on what the most cost-effective solution is going to be. And this is an area where we really know what the technologies are, we have them available, and it is a commercial challenge of how do we bring them to market. If you think about the hydrogen production specifically, it is really carbon capture on the existing ATR or SMR for the methane reforming, or it is electrolysis to produce green hydrogen. And then for ammonia, it's the electrification of the process. And so it's a question of how do we create the right incentives to deploy these technologies. If we go to the next slide, I think on the other side, I just talked a little bit about supply. If I shift over to the demand side of the equation, and you can think back to the slide that Thomas just shared, where he was referring to the left side supply and the right side demand. On the demand side of this picture, we are seeing food and beverage companies increasingly make commitments to decarbonize their Scope 3 emissions or their supply chain emissions. And so to me, this is a sign that the buyers, the right-hand side of the chart that Thomas shared, really are interested and engaged in solving this problem. They're making public commitments to do so. And in some cases, you're actually seeing early commercial deals, such as the example of the Pepsi Yara transaction that we see at the bottom of this page. The challenge then comes in on the next page. If we have supply that knows, the technologies they need to pursue, albeit with commercial challenges, the demand is saying we want to come to the table and decarbonize our supply chain. The question becomes what's getting in the way. And so we return to the value chain page that Thomas shared a few minutes ago. And fundamentally here, what we see is the manufacturing side of the equation are large industrial producers with high capital expenses, often with some degree of demand uncertainty and cyclicality in this market, thinking about natural gas prices, are all challenges that these producers face. And generally speaking, industrial producers operate with compressed margins. And so asking them to take a big risk on changing production processes without knowing they have a customer is a very challenging proposition, as I'm sure many folks on this call can empathize with and understand. The challenge really comes in the middle of the value chain when you think about distribution and retailing and farming. And there are two challenges that I would draw out here. One is the large number of intermediaries, particularly starting with the distribution layer, make tracing the low carbon product through this value chain very difficult. And so that is a logistical challenge of, if I'm downstream, how do I know I actually got the low carbon product, right? What are the accounting mechanisms? How can I trace that through? The second challenge, though, is adoption, both for the distribution and retailing layer, but particularly for the farmer layer. Asking those stakeholders in the value chain to accept a higher cost for their inputs really requires them to be able to say, and I know my customers will cover the entirety of that cost and maybe more if I'm taking a risk in changing anything. And absent that kind of assurance, it is very unlikely that those layers of the value chain are going to adopt a lower carbon solution when, to Thomas's point, the molecule is the same. right? And the function and impact to yield is effectively the same. And so why would we as participants in the middle of this value chain take on that risk? One challenge as we then look at this is it introduces an enormous coordination problem of you might have real demand on the right-hand side of this chart, but for them to be able to pass that through, and to Thomas's point, in the volumes necessary across this value chain to actually get to the single producer upstream that's making an investment decision is an incredibly complex task. And even if you were to tackle that, trying to line everyone up around a table and say, great, how are we going to, pass this through is a problematic endeavor. And so if you go to the next page, this is an alternative solution to that problem that we see and that specifically RMI and GMA are in the process of developing. So rather than trying to pass a changed or transformed physical commodity through the entire value chain, what you can do is actually decouple the emissions intensity attribute from the product and sell that separately. The way this would work is an upstream producer, either ammonia or fertilizer, invests in an intervention to lower the greenhouse gas intensity of their production. They sell the physical product on just as they always have with the pre-intervention emissions intensity associated with that product. And they take the reduction in emissions intensity and effectively put that on an environmental attribute certificate. So this is a new product they are creating. It will say, 1 ton of ammonia, or it could be any type of fertilizer that we could talk about here too. And that's something that we'll continue to engage a number of producers on over the coming weeks and months. And issue, instead of 2.4 tons of CO2 per ton of the product, perhaps this new post-intervention product is only 1 ton of CO2. And they can sell that reduced emissions intensity to the downstream brands that are interested in managing their scope 3 emissions to apply against their corporate emissions inventory. If we go to the next page, I want to highlight quickly, there's a precedent for this, right? And I think this is a really important part of this conversation because otherwise it can be an out there concept to decouple the emissions attribute from the product. In energy markets, we saw this happen because utilities were mandated to only care about the electron and the price of the electron. And yet you had downstream corporate buyers that wanted to manage their scope 2 emissions. They did care about the environmental attribute, and they really couldn't go to the utility and say, this is the kind of power I want to buy. There wasn't a mechanism for that. And so what we saw was the creation of renewable energy credits to allow project developers in the energy generation space to unbundle the emissions attributes of the power that they were producing and sell that directly to corporates. What it gives corporates downstream is more choice. I will just note, for the sake of time, we've seen this emerge in industrial sectors as well. And so sustainable aviation fuel is another example where this emissions attribute is actually decoupled and sold separately. To make sure that I'm leaving time for our other presenters, I will skip the details of that example. So turning now to what GMA and RMI are working on together. We are developing a pilot procurement for low emissions fertilizer. We know the chemicals sector is a meaningful challenge, and we've really kind of summed up why on the left-hand side of this, and where I'll focus is the right-hand side, which indicates we are in the process of aggregating buyers to try to go out to market to purchase low emissions environmental attribute certificates for fertilizer. So effectively using the system we described on the last page, pooling their demand to try to help bring incremental supply side projects forward to FID. And I will just briefly note that as we apply this approach, we really do 2 things. One is we design that environmental attribute certificate or book and claim system, which is what you see here on system design and build on the left. And in addition to that, we work with buyers in the space to aggregate that demand and bring that demand to market in a consolidated way. That does 2 main things in my mind. One, it makes it marginally easier for the buyers to engage. We can share best practices, we can streamline the efforts, and hopefully in so doing, we can bring more demand to the market. The second thing it does is it actually can concentrate that demand to a single project. if everyone is doing this individually, the demand may otherwise actually fragment out to a number of supply side decarbonization projects such that none of them have sufficient volume to get to FID. And so by moving together, by establishing joint procurement criteria and evaluation criteria with that group, we can ensure that sufficient demand actually moves to a project to help get that project across the line. And then very briefly, why we believe this works and why we know it works is we've done this in a number of sectors. This is a combination of GMA and RMI and joint initiatives that each of us have pursued, but we have actually seen the model that I have described work now across a number of sectors. And often it starts as a small model to show, look, you can build these systems and there is a willingness to transact through it. And that's why we're describing the work we're undertaking now in the fertilizer space as a pilot. But ultimately, what we have seen is after 2, 3, 4 procurements, you begin to see scale up of the demand and the volumes here such that you are talking about really significant volumes that can bring a new facility online. And the aviation example in the top left is what I would point to there. So with that, if you all are interested in learning more, what I would say is please engage with us. First, for fertilizer producers on the call, particularly those that may produce low carbon fertilizers, we will have an RFI that will likely be released in late Q4, early Q1 for you to share a little bit about your solutions. If you're working with food and beverage companies that are trying to tackle emissions in their supply chains and you think they would benefit from our approach, feel free to introduce them to us. We would be happy to connect and try to really further their journey. And finally, if you have questions, you can contact us at chemicals@gmacenter.org, and we would be happy to find time to touch base. With that, I'll pass back to Patrick.
So thank you, Andrew, for very inspiring presentation, let's say, and presenting your approach, combining both demand aggregation with book and claim system. By the way, we will be very pleased to help with your RFI and the RFP to make sure that you get the needed input from the industry. Now I'm pleased to welcome our third and last speaker, José Antonio de las Heras, who will present the producers' let's say, perspective on that topic, building on the Fertiggy model. So over to you, José Antonio.
So, hello, everybody. Thank you very much for the invitation. Thank you very much for everyone joining the webinar. My name is José Antonio de las Heras. I am the CEO of Fertiggy. Well, I have an engineering background, 30 years experience, half of it in energy industry, oil and gas, renewables, and hydrogen. Okay, so please, the next slide. Well, what's Fertiggy? Fertiggy is a company which was created 2 years ago. I was the first employee. I'm not really the founder of the company. Behind this idea, we have 6 corporate shareholders, which from the very beginning understood that it was very, very relevant to cover the full value chain. So in our case, from the beginning, and this is a webinar about demand creation, we were lucky to have 2 companies which wanted to really be involved at the producer side on how to stimulate not necessarily the demand they understand they have it, but also to have alternatives to the existing potential supply chain. So these are InVivo and Heineken, which are actors in the food and beverage and agro industry. We also have 2 shareholders which are more related to the industrial ecosystem, like Maire and Siemens, which also have a financial role. And then we had from the beginning investors related to energy and regulation and promoting the business. Okay, so the scope of Fertiggy is to develop greenfield projects, which means basically it takes us 6 years from the idea of where to develop one of these facilities till one of these plants is operating. And the scope for us is really to produce a final product, which is a low carbon fertilizer. In our case, low carbon means electrolytic hydrogen. And the approach is to have a fully integrated plant where we produce on-site hydrogen, which is converted fully into ammonia to convert it fully into fertilizers. Okay, so Well, what is the context? I don't think I need to go beyond what has been said today and in the previous webinars about the impact of fertilizers on greenhouse gas emissions. What we have really approach here for us is the European content. Okay, I think this is a worldwide challenge, but in the particular case of Europe, I think Europe is leading all the decarbonization efforts, which are not easy and really are bringing a lot of discussions about the timing and really the depth of this decarbonization. And what we found in Europe is, on one side, there is a new regulation coming where the fertilizers which do not pay today taxes under the emission trading systems will pay taxes in the future. Okay, so this is more like a stick approach, but it's quite relevant. We will come later to the willingness to pay. Okay, this willingness to pay in many cases today is meant that most of the introduction of the low carbon fertilizers will be below 1% of the final product, but this is still a lot of money for the food and beverages companies. But if you consider a longer period, for example, 2030 to 2040, the potential premium will be much lower than today. So I think in order to create a market, it's important really to understand which is the long-term pricing of the fertilizers. Okay. At the same time, it was already mentioned today, we have focused our demand on the voluntary targets of food and beverages companies. Okay, there is a lot of, and we think it would be positive to have, let's say, public moves to really promote demand for fertilizers, to have subsidies for the farmers and so on. But this may not come so soon. So basically, our business model approach is very much based on these voluntary targets. Okay. So when these companies which have voluntary targets, once they have a specific volume of emissions, it's difficult for them, or it's an obligation to define Scope 3 targets. And for many of these food and beverages companies, the Scope 3 targets are very much related to agriculture. When it comes to scalability, there are not that many paths to achieve the emissions reductions. Okay, so next slide, please. Okay, so what's our approach? Our approach, as I said, is to develop an initial greenfield facility in Europe where we will achieve a significant reduction of emissions. Our facility will be located in northern France. These are very convenient locations to supply the French market, but also most of Europe. And the approach here is a little bit different. So basically, in our case, because each of these investments is above 1 billion euros, will require long-term agreements. Okay, so for us, some of the alternatives which have been presented today will be not so easy to implement, as we don't have an existing corporation really to do those investments. We basically in the project where from the beginning there is a long-term commitment from the off-takers, which is like 10-year price. And in many cases, this price needs to be fixed in order to finance the project, like similar to what has been announced recently for a project in Paraguay, which has signed this first long-term contract with an off-taker. Okay. Next slide. How do these companies approach the emissions reductions? Okay, so they have these corporate targets, and basically they need to show or achieve the results by 2030. This is a first wave, and there are other, let's say, targets for the period 2040. Okay, so basically when these companies look at the different alternatives, they end up coming to the conclusion that its scalability is very, very important. Okay, so basically, in the case of low carbon fertilizers, for example, together with regenerative agriculture, they have the opportunity to go at scale. Okay, in this case, going at scale, for example, if we consider the total production of the beer market in Europe, one new facility could cover most of the needs of the beer market. Okay, so basically, we are targeting a niche market, but a scale market. Okay, these 500,000 tons, maybe not a big quantity if you consider, for example, 10 million tons nitrates demand in Europe, but really it can cover really the needs of many of these food and beverages companies. although we believe that if all of the companies move at the same speed, there will not be enough supply to cover the demand of the companies. Okay, so basically, there are certain limitations to cover all the demand if all the food and beverages companies would like to cover their needs in Europe. Okay, basically because there is limitation to retrofit the existing plants to low carbon fertilizers, and there are not that many, or most. I think our project is one of the only ones which are completely greenfield in Europe. Okay, so volume here is very relevant. Okay, so then we will come also to the integration of the value chain. Okay, I think here it's important in the next slide. I think this is very similar to what my colleagues have discussed. You have on one side companies with the willingness to pay. This is at corporate level. At the same time, these companies, in many cases, do not buy fertilizers today. And for sure, they do not want the fertilizers to be delivered to the headquarters in the future. Okay, so basically, there will be a different move of physical product compared to the financial, let's say, obligations. It's also true that the bankability of these food and beverages companies is much higher, for example, compared to other actors. For example, let's say processing industry, like malting companies and so on. And basically, when you go to the farmers or the cooperatives, really the approach has to be more like a prescription. Okay, so basically we would follow here more like a pull strategy, where this prescription comes from the food and beverages to the processing industry, where these two request the cooperatives and farmers, which, for example, in the case of France, are very much involved in supplying the inputs and buying the crops for the farmers. So basically that they understand if they engage into these practices, there is a known, let's say, business model where they will be, let's say, compensated for the extra cost. So they will sell a product at volume, an extra premium, and these premiums will travel across the value chain. Okay, good. And so coming to the model, okay, how do we see really this happening? I think, as we were saying, is quite a complex approach. For example, in our particular case, we have been approaching food and beverages companies and processing industry, which in some cases are also big volume cooperatives, where basically everyone understands that this premium needs to be paid by the food and beverages companies, which do have to a certain extent the capacity to pay the premium. There is a discussion at this level if the consumers or the marketing people within the food and beverages companies do see the options to pass those premiums to the consumer. I think as of today, this is happening more at corporate level, like with the brand, with the reputation. So we do not see short-term really in the linear, like having a kind of beer, like where you can charge an extra. But I think as a whole, let's say a brand can really charge higher than a white brand, basically because of many reputational issues. And within those topics, you have also sustainability. So basically, this discussion about the consumer paying the premium may not be necessarily because they are buying a low carbon beer, but they are buying from a, let's say, responsible company, as a whole. Okay, so basically the type of demand is coming from the consumer to the food and beverage company, but at the same time, it could be the case that the food and beverage company may not want to sign directly with the producer. So in this case, you need to engage, for example, with a processing industry, which is willing to take this financial responsibility over the long-term demand, always knowing that they have like a back-to-back contract from the food and beverage company to buy the agricultural raw material from there. So this is an alternative. That's why we are having discussions not only with the food and beverages companies, but also with processing industry, which, by the way, in many cases have very strong relationships with the food and beverages companies. And it's a way to solve from the beginning the complexity, not only from the financial commitment, but also to start discussing how would the supply chain would work. Okay. Okay, so basically, how we see the success factor for this. Okay, on one side, and this is very particular for Europe, since let's say the Ukrainian conflict, there is a new approach about really sovereignty. Okay, so in many cases, there is a discussion only on competitiveness. We believe we need to be competitive in the field of low carbon fertilizer. So basically, a company who is not really willing to decarbonize, it's very difficult to consider that the long-term, let's say, competition is about low carbon fertilizers being the same price as great fertilizers today. So basically, you need really to define if your customer is really willing to decarbonize. So in this integrated approach, where basically the fertilizers are produced in Europe with no potential logistics disruptions and based on, let's say, European electricity, water, and dolomite, is an approach which, not for the whole of the market, but for a niche of the market, could be also a hedge for the industry, okay? Because sometimes the consideration is what's the cost of these fertilizers, but if there is an interruption in the fertilizer, let's say, supply chain, this could also be a problem with much higher impact than the extra cost of the fertilizers, okay? And there are a lot of, let's say, geopolitical things going on today regarding where the LNG will come from, at what price, and so on. So basically, this sovereignty approach for Europe is quite relevant. In our particular case, we believe that long-term SBTI may not be so, let's say, flexible as it is today with a mass balance or a book and claim. So in our case, for the fertilizers, we are proposing a physical segregation where basically all of the fertilizers produced by us can be basically traced, so that you have a product where the decarbonization is very much linked to the product, okay? And in the case of pricing, today you have the volatility of the pricing linked to the natural gas. Natural gas today for Europe is mainly LNG, but in the future you will also have the volatility of the CBAM. So no one knows exactly how much you will have to pay for CO2. At different levels of CO2, even let's say low carbon fertilizers could be less expensive than the total cost of ownership for gray and fertilizers paying the ETS taxes, okay? And the final approach, as we were saying, I think for newcomers like us, we taking let's say the complexity of the supply chain from the very beginning. We do have inside really players on the industry. This is an advantage because this means that you can take the time, and you already have companies which are taking. I would not say that not all the food and beverage companies are taking it seriously, but they have different timelines. So by having inside the company, let's say, players of the supply chains, it allows us to have a very direct discussion about how to solve the complexity problems of the long-term pricing of the supply chain, also how to calculate what are the long-term views, because in many cases it's not about being competitive, it's that it's very difficult to determine today what will be the price in 10 years. No? So in many cases it's difficult for the off-takers also to take place. Okay. Thank you very much.
So thank you, José Antonio. So we are a bit behind. I will just ask one question to each of the panelists, and then we will move to the Q&A. And I've seen that we have already almost 20 questions. Maybe starting with Thomas. So how can we ensure that the demand signals are credible and bankable so that producers can invest with confidence?
That is a good question. I don't think there, bankability in many cases is really a matter of offtake, not price. The price is more a proxy. So we have we have we're using modeled price, because these assets are not built yet in many cases. We don't know what the market price will be. We are guessing, we're qualified guesses with our models, right? We're trying to understand what the cost differential would be. And the reason we do this is that if it's cheaper, then the demand question will be very simple. Everyone will buy the low carbon product because it's cheaper. And then honestly, in that kind of scenario, we wouldn't need these complicated supply chains, because it will be a sort of self-reinforcing transition. Now, that is not within, I think, that's not within. We don't have patience, I guess would say. We don't have patience for policy support to be sufficiently strong to really incentivize price-driven competitiveness anytime soon. So we will have these green premiums where someone will have to pay extra. Now, in the cases we have seen price signals really translate to first-of-a-kind offtake, honestly, it doesn't happen until you have ink on paper on offtake. So either you have take-or-pay contracts that we have seen in other sectors, which are some customers being quite willing to take risk in order to incentivize investments, or through facilitated procurement programs where you start triangulating the price with more precision. So you go with RFPs to the market to get the bids, you get a clearer view on the price delta that you will actually have to pay, which is much more credible than an Excel spreadsheet, right? And then the off-takers are actually willing to sign up for the offtake at that given premium for one round of offtake, or maybe for a 5-year period in some sectors. And at that point, the demand signal becomes bankable enough to underwrite investments.
Okay, very interesting. Andrew, regarding aggregated demand, from your work at GMA, what are the most, let's say, effective ways to bring buyers together to aggregate that demand?
There are a couple of things I'll note here. I think one is, and it's a point that both Thomas and Jose mentioned, you really need the buyers that are ambitious in the room. And so I think finding the right buyer group to start with is a critical aspect of this, because they are then going to drive meaningful conversation amongst that group and kind of push each other and I think expand the bounds of what is possible. I think a second element of this is really investing the time in education, both about the available technologies and the potential price premiums and the trade-off, and even how those technologies will develop over time. I mean, Jose mentioned a little bit about where we're actually going to see cost out in some of these technologies versus others. And I think getting the group to a theory of change that is really informed around those technologies is critical to actually activate that demand and keep it sustained. But then the other piece that we have to make sure that everyone is really up to speed and informed on is the system. Because particularly in these book and claim systems, all of the participants have to be very confident that the structure of that system results in real emissions reductions, that there is not the possibility of double counting in the system, that it is fundamentally high integrity and actually driving change. And so making sure that we're taking the time to have those conversations to build that confidence, I think is critical to getting the most out of those demand aggregation approaches.
Okay, and it is the right time, let's say, for the food industry and the fertilizer industry to engage in a very constructive dialogue between both, probably.
Very much so. And to Thomas's point, we're running out of time on that, right? And we're already behind schedule. And so I think it's critical that we're driving these conversations now.
Absolutely. The good news is that we are doing it. That's so. And to you, Jose Antonio, there are a number of questions in the chat box as well about farmers. And so how do you engage with, let's say, downstream players, including, let's say, food companies, retailers, but also farmers? So in order to ensure market uptake. So what role for farmers in particular here?
I mean, I think the engagement with the farmers, it goes through the cooperatives. The cooperatives have, which in many cases are, in the case, for example, of France, at the same time they are represented in the processing industry. They have engaged with the, let's say, most open-minded farmers, where basically they have discussions about, let's say, sustainable practices, which are part of a specification. And based on the following of such practices, the farmers agree with the cooperative to save like a premium crop. Okay, that is how you engage with the farmers. So basically, you do require farmers which are willing to play this game, let's say, of sustainability. Other farmers may go for, let's say, the mainstream market and so on. So basically, you do require to have farmers which are willing to really take, let's say, a risk, but this is a risk which is basically controlled risk, where they, by following certain practices, they will access to a market, and probably this is more a European market, and maybe it's not solving the issue of a farmer who is thinking about export markets where price may be the only attribute. No, but if you're considering a market where basically there is a demand for sustainable crops and so on. So you have to find the right farmer, which in many cases are businessmen. I mean, this is not just a farmer. In many cases, we are talking here about a businessman with a company which really understands which are the potential upsides or risk of engaging into a market like sustainability or staying outside that market. Yeah.
So maybe a related questions to Thomas or Andrew. And in the case of smallholder farmers in developing countries, so how would they potentially benefit from such, let's say, market opportunities? Or will they be excluded?
I think it's a good question. I think there are ways of making their business more stable and take away some of the current market volatility that they might be exposed to, because the cost structure for some of the production pathways at least is more predictable and more stable, and you're not exposed to the cost of in worst cases LNG for your fertilizer product, right? And in very few cases are the farmers able to pass that cost along to the next step in the supply chain, right? So they do have some real margin squeeze exposure for their production setup, right? So to the extent you can, enable a more localized regional supply chain without the global price exposure, taking away the need, taking the investment support away from, sort of bringing the investment support, I would say, to enable the investment for the local supply chain. I think that could lead to a much more stable operating environment for those farmers.
I agree with
Okay,
that.
then, yeah. Yes, go ahead, Andrew.
I mean, one thing I would briefly add there is, I see an eventual world here where efforts like Fertigui or what we are trying to do with the ACs can really demonstrate that there is a differentiated market for sustainable product, and that the food and beverage companies are willing to pay for that, right? And so I think that if we can sufficiently demonstrate that is a viable and meaningful market over time, that opens up opportunities for farmers, right? And I think until that is demonstrated, it's very hard. But once we actually see that, we see a willingness to pay, I think entrepreneurial farmers, at least a subset of them, can see that as a growth opportunity as well. I think the other thing that I would note here is if you think about the physical supply chain, let's say there's just one set of producers all the way through. If only low carbon fertilizer is produced, everyone in that supply chain actually gets the credit for the low carbon fertilizer along that path, right? The distributor does, the farmer does, the food and bev brand does. And I think that there will also be ways as these systems are developed for the food and beverage brand that buys an EAC to lower their emissions to credit the folks in their supply chain with that emissions reduction to effectively buy the attribute for all of the layers of the supply chain they work with, and actually then develop deeper relationships between the food and beverage brands or the processors and some of the farmers upstream. And I see it as an interesting opportunity for the food and beverage brands that have paid for the emissions reductions to go to farmers and say, look, I would love to give you the EAC credit for reduction in the fertilizer emissions, but I'm going to need your help to adopt regenerative agricultural practices in order to do so that we can deepen this relationship. And so I think there are interesting opportunities that come off of the development of these systems and markets for deeper integration in some instances between the processors and the farmers as well.
So, and one more question to you, Thomas or Andrew. So what about your, let's say, what are you discovering as the biggest challenge to credibly create EACs for these fertilizers? And will the book and claim approach serve growing sectors using ammonia beyond agriculture, for instance, the shipping industry?
Good
I'll take it.
question. Go for it,
I'll take a
Andrew.
stab, and then Thomas, please feel free to add. I think the biggest challenge is, for folks that step back and look at this value chain, the coordination challenge is very real. I think that there is a very understandable desire for many brands to maintain the physical connection in their value chain. And to be very clear, I believe that it has to be both. That it has to be EACs to catalyze and stimulate this market, and we're going to see a lot of physical procurement as well. But I think that the journey of the downstream companies, the food and beverage companies, realizing that solving this only through physical procurement just isn't going to move fast enough, and that adopting market mechanisms to try to catalyze some of the early projects and create early momentum and market traction here is necessary. We see some companies that are very much there, and we see some key demand players that are still trying to think through, how can we just do this in the physical space? And I actually think that it is the evolution of that thought that will be one of the biggest breakthroughs in these markets, because as you get more demand pouring in, the market pull will just become stronger and stronger. Thomas, I'm curious for your take here too.
I think a general challenge we have in setting these supply chains up is ensuring additionality, and while at the same time supporting both greenfield and brownfield solutions, right? I mean, in the greenfield case, it's a little bit easier to say a new asset was built, so therefore we have impact or we have additional low carbon capacity. I saw a question in the Q&A here, especially on that, if you're not addressing the brownfield, are you then actually reducing emissions, right? So this is not an easy issue to resolve. In the end, I think for these voluntary markets, which are distinctively different from regulated markets, to be clear, right? We are not, with these mechanisms, in the business of, if you like, raising all the boats and impacting all operating assets in the world. We are, in the near term, quite specifically trying to trigger first-of-a-kind investments and spearheading solutions that are not going to be invested in the current policy environment. I mean, the longer-term theory of change is, of course, that we can bring the cost down so that, you don't have to over-subsidize through policy to really cover these really expensive first assets, and you don't, so I think very specifically for the first of a kind, it is really going to come down to which solution is more cost competitive with credible additionality claim, right? And again, let's see what that exactly means in this complex supply chain. That's part of the work.
So big thank you. Unfortunately, we have to stop the webinar at this stage, despite let's say many more questions in the chat box. So thank you very much to our speakers, Thomas, Andrew, and José Antonio. If you have shared your insights, that was great, and as well, thank you to all the participants for your, let's say, active engagement today. As a wrap up, I would like to highlight a few key messages. We have heard that differentiated demand and low carbon ammonia and fertilizers is emerging, but it is fragile still at this stage. It must be made credible and bankable to support investment, and it will require coordination within the agri-food value chain, and we know that's a complex value chain. So certification, aggregation, and innovative partnerships will all play a key role in this respect. So as we move forward, the challenge is to transform pilot demand as developed at the moment by GMA, by Fertigui, into systemic demand, and to ensure, in fact, that the low carbon fertilizers can scale quickly enough to contribute to the global climate and food security goals. Thank you again for joining us, and we look forward to continuing this important conversation with all of you. Thank you.